Another rate cut in April is what we were expecting, but instead, the bank's rate held at 2.75%. The Bank of Canada is trying this wait-and-see approach, which makes sense considering how uncertain the impacts of the US trade war will have on Canada. Home buyers and sellers are doing the same exact thing, which is why I'm telling you that the Bank of Canada is not smarter than you. Because if you're watching this video, you're probably interested in knowing what's happening with the real estate market, but not doing anything just yet. You're also waiting to see what shakes out from the current economic situation and if it will lead to a recession. The bank's main job is to keep inflation within 1 to 3%, ideally at the 2% target. It's currently at 2.3% as of March. What's surprising is that inflation actually came down even after Trump's tariff announcement back in February. US tariffs can lead to higher inflation through higher import costs. In basic terms, tariffs are another tax that companies have to pay. Those companies are likely to pass down the added costs onto consumers. This leads to higher prices for things that you buy. For example, GM vehicles get their steel from a steel producer in Hamilton, Ontario in Canada. That steel producer has to pay a 25% tariff to get their product into the US. So they raise their price on steel so they can still make money and stay in business. GM in the US is forced to pay a higher price to buy steel from Canada. GM would also offset these higher prices by raising the prices of their vehicles. If they don't, they could be selling their vehicles for less profit. Back in Canada, buying a GMC truck or a Cadillac EV is now going to cost more because of US tariffs. Okay, so we want to keep things affordable for Canadian consumers, but the bank didn't lower the policy rate to stimulate spending. That's weird, right? Cutting rates stimulates the economy, but risks making inflation worse. These tariffs are meant to protect the US, not Canada. They're essentially a hidden tax on Canadian consumers, driving up the prices of the things that we buy, which could lead to higher inflation across the Canadian economy. I've already said that rate drops since June last year haven't done much to the overall GTA real estate market. More buyers got back into the market and they're looking at homes again and making offers, but it hasn't been enough to move the needle on housing supply or home prices in a major way. In fact, new listings over a 12-month period before the first rate drop in June 2024 were at 18,612 in the GTA. That's between May 2023 to May 2024, when the bank's key interest rate stabilized at 5%. By May 2024, the average price for a home in the GTA was $1.7 million. 7 interest rate drops later to where we are today, and new listings over the last 12 months have actually trended down. New home listings that came to the market in the GTA fell to 17,263. The average home price also fell to $1,093,000. So the key interest rate fell by 2.25%, which also caused mortgage rates to come down, yet new listings and home prices came down. Here's how you can make sense of this. As mortgage rates came down, buyers gained more confidence to get back into the real estate market. They're looking at homes again and making offers, but the problem for those buyers is that their options are limited to a certain degree. New listings were down year over year. Homeowners preferred not to list their homes for sale because they'll try to wait for home prices to go up, which realistically could take another 2 years. When prices start trending up, that's when more listings come to the market at higher prices. Even though prices would be higher, the fear of home prices going up even more also creates more competition for buyers who are now competing for the same properties. This is what happened in 2017 when the bank's key interest rate was practically zero at 0.25%, and also in 2022 after the market recovered from the COVID-19 pandemic. The difference right now is that the US is creating uncertainty in the real estate market. So another drop of 25 basis points wouldn't make an impact to overall consumer confidence. That's why it made sense for the bank to keep the key interest rate at 2.75% in April and try this wait and see approach as they get more data about inflation and the overall impact of the trade war with the US. Home buyers are doing the exact same thing, which is why I say the bank isn't smarter than you. This is still a buyer's market, and yet a lot of buyers are also waiting to see what happens. Maybe home prices will go down, and that's great, but if they don't, they're not going to shoot up overnight. It's not like the stock market where prices are changing every millisecond. So anyone active in the real estate market can react fast enough to take advantage of the current market condition. I don't think prices are changing much, but if they do, it wouldn't be by hundreds of thousands of dollars. This already happened compared to home prices 3 years ago. It would be great if we saw the average home price fall back to $900,000, but we haven't seen that since 5 years ago in May 2020. Even though home prices aren't back to $900,000 today like they were in May 2020, they're still down down 5.5% compared to just 1 year ago. That home you were looking at for $900,000 last year is now selling for $850,000. Buyers are not flooding the real estate market today despite lower home prices and lower mortgage rates, and also not just because of US tariffs, but because of how risky the job market is right now. Ontario Premier Doug Ford said the US tariffs could affect employment, costing about 500,000 jobs across Canada. Job insecurity makes it more difficult for home buyers to qualify for a mortgage, so when income is unstable, locking into a 30-year mortgage can turn out to be a huge financial risk. If we see a rise in job losses, this could contribute to a recession. Global events that have triggered a recession in the past were the financial crisis in 2007, that lasted about 2 years, and also the global pandemic in 2020 that lasted about 3 years. Some economists are saying that the increasing recession risk in Canada could prompt the Bank of Canada to lower interest rates at least 2 more times this year, which isn't all that surprising considering we're only in April and there's still 2/3 of the year left to go. The odds of another rate cut this year by the Bank of Canada is possible as we start seeing signs of a slower economy. So as someone who might be trying to buy a home in this market, what do? If you're in the market right now as a buyer and you are in a buyer's market, you can negotiate a lower price on your home. Properties are sitting on the market for a month on average these days. I've seen so many listings taken down and relisted several times, usually at lower prices each time. Average home prices are low and it's unclear how much more they'll go down, if they'll go down anymore. The detached home market segment is still strong and you'll find some competition there, so be prepared for that. But if you're looking at condos, take your time. Some parts of the city are seeing condos sit on the market for more than 2 months without being sold. And by the way, if you made it this far into the video, I just wanted to say thank you. My name is Fred Tam. I'm a real estate broker in Toronto. My goal is to help you reach your real estate goals by providing the best real estate tips and market updates. So if you enjoyed this video and you learned something new today, subscribe for more to stay updated and I'll see you in the next one. Thanks for watching.